Okay, we're back still talking about socks, which I'm writing with the greed color of the day. Uh, Hoping that will go away from my profession. Okay. All right, that was an interesting discussion we just had on the last video. What other things do socks do? Well, it prohibits accounting firms, and this is part of hopefully the controls from audit failures. It prohibits accounting firms from actually consulting with the companies they are auditing. So imagine if here's the scenario. This is like what the picture was when major audit failures were happening in the late 1990s and early 2000s. This was the picture. This was the audit. Pretend this is a company, and the CPAs are down here, and they're doing the audit, and they're also doing consultation. And this picture is going to be a little bit skewed, but it's going to be a pretty good it's going to give you a pretty good picture of what was going on. So the audit is a necessary evil. You must have it under the Securities Exchange Act, as you know. And so the audit might have been looking like this. Maybe it was a couple bucks to get the audit done, because nobody really wants to pay a lot for an audit, so how cheaply can you do it? And the marketplace gets very competitive. Meanwhile, the CPA firms have tremendous amounts of innovation on staff. They've got, let's face it, accountants are smart. I said that modestly. No, we're good business people. We see a lot of businesses. We get to compare what makes one business successful to another. We learn a lot about data. We know how to work with data. We know how to interpret data. And so for consultation work, that's what it looks like compared to audits. The dollars are big. The dollars are meaningful. But because this makes companies money. When they pay for consultation, they make money, we make money, and so we charge accordingly. They're going to make and they're going to pay. They like to pay. Companies like to pay for the consultation because we help them make more money. So the audit was being given away almost like a loss leader in a grocery store, and the consultation was where the money was to be made. So let's look at this picture and say, what if just one CPA firm is doing both? Well, if there's a problem here, the CPAs are going to say, it's better for us. Imagine this. Okay, you gotta imagine this. What if there's a problem with the audit and the CPAs discover that this company, if the audit is done a certain way, the right way, then the public's going to find out that this company's got issues. The stock's going to go down. The company might go bankrupt, or at least it might affect the operations of the company for years to come, and they won't be able to pay the big dollars for the consultation. Can you imagine the CPAs saying, oh no, we're going to lose all this revenue? And then there's that little face like that. So the CPAs this is what happened. The CPAs were afraid of losing all that revenue, so they started looking the other way. They closed their eyes on the audit. And hence, Sarbanes-Oxley says, enough of that. If you do an audit, you can't do consultation. If you do consultation, you can't do an audit. And that takes this picture out of the equation and hopefully reduces the audit failures, because you no longer are looking at an audit as a loss leader. Your client is an audit client. That's it. That's all you do. You are allowed to do a tax return because that's not really consultation per se, but most of the big four firms will not do both an audit and a tax return. They don't even want to get close to any appearance of having a lack of independence. So CPA firms actually go beyond the letter of the Sarbanes-Oxley law in avoiding any type of work that might compromise their ability to be good auditors. Another thing done was lead audit partners must rotate off the account after 5 years. That means that the following, and I think you can imagine this, even if you're not a business person, you can certainly well imagine the audit partner of a team. Let's use EY. There's a partner who's the lead person on an audit, and they're doing an audit of a public company year in, year out for 5 years, and you know what happens. Boys will be boys, and girls will be girls, and people get friendly, and they get social, and they get to know each other after a few years, and suddenly it's no longer auditing from the standpoint of a independence of mind and a mind where it has the ability to separate from being a enforcement or policeman in the audit world, in the accounting world, to being a friend and trying to help somebody out. That independence can get warped or overlooked if the friendliness gets too great. So the fact that the audit partners in the firm must rotate and somebody else has to come in and take over that after 5 years is a way of, or it's a hope of a way of reducing the audits from being compromised due to just plain old human things that happen. So that's what that does. There is an argument that it shouldn't be just audit partners, it should be the audit firms themselves. Get everybody out of the picture so that nobody's left friendly with the people inside the company they're auditing. The CPA profession sort of screamed at Congress, don't do that, you'll kill us, we won't be able to handle it. It's the first year audit costs a lot of money. That was the excuse, because the first year audit you have to do a lot of setting up your work papers, and you have to do a bunch of things for the first time that you don't have to do on repetitive audits, and so it would cost a lot to the marketplace, and the public companies wouldn't be able to afford it, was the argument the CPAs used. I don't know if that's a good argument, but that's the argument they used, and they won the day. So EY could keep an audit client for 10, 15, 20 years. They just have to change the audit partner every 5 years. So that's another checks and balances to reduce corporate fraud in these public statements. Here's another one. I don't know what number we're on, but let's say it's number 4 because we promised 4. Sarbanes-Oxley protects employees that report the fraud of corporate fraud or manager fraud. So there are many federal laws and state laws that protect whistleblowers, but our governments seem to think that they're not protected enough because they still get ostracized. They still have issues where they don't want to come forward. They don't want to testify. Or why do I need this problem? I don't want to get involved in the problem, as they say. So Sarbanes-Oxley felt it needed to just be yet another nail in the coffin of whistleblowers from not saying anything. So here's yet another law we could probably, if I had some time, I could probably write down, I don't know, 5, 6, or 7 or 8 laws that deal with protecting whistleblowers that are out there, just the federal government side. Maybe we'll do that as an exercise. I'll see. So Sarbanes-Oxley comes along, and they have penalties for anybody who violates protecting whistleblowers. They have sanctions, and the whole act helps keep whistleblowers from trouble. The law says they can't be reprimanded, they can't be fired or blacklisted just because they blew the whistle on corporate fraud. Okay, so that's good, we hope. All right, here's another one. This might be number 6 or 5 or who knows, I lost count, but more things that Sarbanes-Oxley does. No loans from the company to the executives, no loans. Why? Because what do loans lead to? Loans lead to greed. I want more. I want more loans, and maybe the loans are not, not being written properly. Maybe they're not. Maybe the loans don't have enough protection that the company will get paid back. Maybe they're being made, and the executives can't borrow anywhere else because their credit stinks. Yet the company's lending to the executive because the executive can sort of pass the law. So now CPAs come in and they know there's no loans allowed to executives. So if they see it, they're going to say your audit opinion is no good. That's what'll happen. So that's another protection. All right. We talked about this a bit, but it just bears repeating. chief executive officers and other people in the C-suite. So there are other CFO, COO, other people that have corporate executive in their name of some sort. Like I said, corporate financial officer, corporate officer of operations, or chief financial officer, I should say. Chief of operations, a COO is the chief of operations. Chief officer of operations, CFO, these are the ones. And there are others that could be in this C-suite. The Sarbanes-Oxley holds them personally responsible for errors made even if they didn't make the error. So if it happened in their department, a material financial statement management fraud audit happened in their department, they are responsible. And they can have fines placed against them by the SEC. The Sarbanes-Oxley also requires the corporate boards to hire the auditors, so it's no longer hired by the company. The company still pays the auditors, but they're hired by the board. That's a way of separating the issue of who's paying the bill. It's not perfect, but it's a help. So the boards hire the auditors. They also fire them. The managers of the company can't fire the auditors. And the corporate boards are required to understand, when it says literacy, accounting literacy. They're supposed to understand the financial statements that are given to them, that are audited. They're supposed to be able to read and understand and know what it means, and know whether or not the CPA looks like they're doing their job. They're supposed to have accounting and auditing literacy. So it's accounting and auditing. And they should be able to talk the talk and walk the walk with the auditors so that they know what they're getting, know what they're buying. And it helps because the idea is that they should be buying a good audit. They shouldn't be like saying, well, I didn't know that I didn't buy the best audit. They're supposed to now understand what they're buying. The effect on the U.S. economy we'll close with in our discussion of Sarbanes-Oxley, the SOX Act, or SOX, is that when it first was passed, the cost of doing audits went up dramatically, and this comes from the public companies' profits to pay for these audits. And we're not just talking about like a 10% increase. We're talking about huge increases in getting those public company audits done. The CPA firms, you might say, had a field day of saying, well, now we really got to charge for these audits because we're no longer allowed to have it as a loss leader. We can't do the consultation work at the same time. We talked about that. At any rate, the effect on the U.S. economy was that many foreign companies that were doing business in the United States and listed their stock on the New York Stock Exchange decided, hey, it's too much. I'm not going to list my stock here. And they left the United States. Rather than do business here, they just said, the heck with it. And some U.S. companies said, it's too costly to do business here. I'll just go elsewhere. It's sort of like people, like right now we have a situation where the taxes are so high in Manhattan of New York City, people are leaving Manhattan because why should they suffer the high tax rate there? They can go somewhere else. So that was the initial effect. That caused Sarbanes-Oxley to be fine-tuned, where some of the initial things that came out in the first version of Sarbanes-Oxley were tweaked and made a little bit easier, not to the point where they thought it would fail as a act that kept the financial statements more kosher, if you will, but they brought the cost of admission, they brought the cost and the price of doing these down, and in order to keep the marketplace attractive to the world. Private companies are not required to live by Sarbanes-Oxley, so that's cool. But there is one, that's the SOX increase, the audit cost. There is one thing that nonprofits have to do with, or two things, nonprofit organizations. So this is like one of those, and we'll leave with this. This is one of those trivia questions that are really cool. Do this with your friends over the weekend. Nonprofit organizations. SOX is a law that applies to public companies. We probably kicked that one to death so far. But nonprofit organizations, which are not public companies, have two things under SOX they have to live by, because the law specifically says it includes nonprofits. It's the whistleblower rule. They can't ostracize or otherwise do anything to hurt whistleblowers. And the rule on record retention, and this bears just 1 or 2 minutes. I'm a little bit over my normal time, but it's worthwhile. Record retention, keeping your accounting records, keeping your corporate records, keeping the records of the company that's doing business. Under Sarbanes-Oxley, it's 7 years. The records have to be kept for 7 years, and you can't destroy records once you're under investigation. And so this applies to public companies and nonprofit organizations as well, but not private companies. Okay, that's it. We're good to go.